Welcome to Chapter 2. We're now going to look at combinations from the perspective of acquisition through acquiring stock. We're going to have two entities that we consider, the parent, who's doing the purchasing, and the subsidiary, who is being acquired. Unlike Chapter 1, where one legal entity continues after the acquisition, here you have two ongoing legal entities that continue to exist. So legally, they're separate entities, but economically, they're a single economic reporting unit, which is an example of our accounting concept of substance over form. So the economic substance of one legal entity is how we get to the consolidation. Since we have two entities, they each continue to record in their general ledgers and have separate record keeping, and we have to have a means then to bring them together, and that is the purpose of the consolidated worksheet. Again, I'll remind you that the templates for a number of these problems are available on the publisher website, and you can pick and choose and use whichever pieces of these templates you find most useful. You'll see on my screen that I've pulled up the template for problem 2.1. That's the one we're going to work through here, and I will demonstrate to you the pieces of the template that I use and don't use, but you don't have to necessarily follow my example. When we're doing a stock acquisition, you'll notice the first item up here is that the ownership doesn't necessarily have to be 100%. As long as there is control, that's the important issue here, is not the amount but the control aspect. So in this example we are acquiring 100% in problem 1, so we'll start off with that as our starting point. Now some of the information on the template to me is a little bit of a duplication, so I tend to skip right to what the publishers call the DDE. So I'm going to eliminate these different lines there and skip right down to the DDE. Now if the other parts help you to visualize and put the full piece together, by all means use them. I'm just expediting a little bit in our examples as well by skipping right to the DDE. Now the DDE is a publisher tool. It's a great tool that we used in Chapter 1 to compare the acquisition price to an underlying value, but it is not necessarily something that is required. It's just a tool to facilitate the acquisition. So be aware that some of the things that we look at are developed by practitioners. They're not part of the underlying GAAP, and I would encourage you, as hopefully you've done throughout your accounting education, to actually go to the codification and look up the specific rules. So in this case, the parent is acquiring the sub stock, 100% of the stock, as we already said, and the acquisition is happening by exchanging stock. So there are 18,000 shares. Again, as we did in Chapter 1, we do it at fair market value. So the price paid here is $720. We compare that to the book value. So as the PowerPoint slide, the checkpoint PowerPoint slide specifically demonstrated, you can acquire either side of the accounting equation, the net asset side like we did in Chapter 1, or the equity side that we're doing in Chapters 2 through 6. So here you'll notice we're going to take the underlying book value based on equity. So we go to the subsidiaries trial balance at the date of acquisition, and we pick up their common stock, their paid in capital, and their retained earnings. The total equity in this example then becomes $340. The interest acquired again is that 100%, and total book value then is a function of the underlying equity times the percentage acquired, in this case the same thing. We then compare, just like we did in Chapter 1, what we paid versus what we acquired, and you see here that we have an excess amount. This line becomes real important because it's going to be what we use in one of our worksheet entries throughout the remaining consolidation problems. So I encourage you to make sure that you see that visually. Now, what does that 380 get assigned to? Well, if you read in the text, you'll see that there are several items where their fair value differs from the book value, just like we had in Chapter 1. In that case, we actually just recorded the fair value. Here, the subsidiary continues to exist on its own, and therefore the parent can't force the subsidiary to change their books in most cases. So we have to adjust for the items that do not have book value and market value that are exactly the same. So our inventory is on the books right now at $60,000, but it has a fair value of $80,000. So we're going to assign another $20,000 to the inventory. The land has additional value that's not on the books of $50,000. The building is on the books for $120,000 at net value, but has a market value of $150,000. Therefore, we need to assign another $30,000. Now, with the equipment, you'll notice that the fair market value is actually less than the book value, so we adjust that one in a credit position. Now, we've only assigned $65,000 of that total $380,000 in excess, so any remainder becomes goodwill. And that goodwill is treated just like we did in Chapter 1. So this then becomes what we're going to call our D entry, our distribution of excess, on the worksheet. And we'll see that as we go along. Now in your text, they do D1, D2, D3, etc. It's up to you if you want to go to that level of detail. Sometimes I think that much detail can be confusing, so I'm going to strictly treat all of the distribution as D. I'm not going to specify as to 1, 2, 3, etc. I do want you to get in the habit, though, of completing some kind of analysis to get your excess, and we're going to, in each of the problems from here through Chapter 6, complete a complete worksheet, and I expect that you write out the entries. Because as you're going to see in this first chapter, it doesn't seem that necessary, but as we build the depth of the consolidation and the amount of activity, it becomes real important to have those entries written out. In the inside cover of your textbook is a summary chart regarding the coding that these authors use for worksheet entries, and you're going to see that we create a rhythm of always doing the same kind of things. In Chapter 2, we're doing the consolidation at the exact same date of the acquisition. So this one has no passage of time, and the entries therefore are a little bit different. We'll continue to expand that in Chapter 3, but this is a good jumping off point to get real comfortable with a couple of the entries before we move forward. So the two primary entries that we're going to focus on here in Chapter 2 is what's called the EL entry and the D entry. So the EL entry is what eliminates the fact that the investment account on the parent's books really is the same thing as the subsidiary equity. And when you look at bringing these across into one entity, you can only have things that occur outside of the group. Well, we know in this example that all of this equity that belongs to the subsidiary is not held by anybody outside of our economic entity, and therefore it shouldn't be part of the final consolidated financial statements. So in our EL entry, we're going to eliminate the common stock, paid in capital, and retained earnings for the subsidiary. These amounts for this entry come directly from the worksheet because we want to eliminate that. And then I'm going to take the sum of these, and that is credited to the investment. As you saw in your reading and some of the materials that are available, there's a direct relationship between the underlying equity of the subsidiary and the investment account of the parent. So that becomes our EL entry, and we're going to then post that on the worksheet. So kind of back to beginning accounting, You record an entry and then you post it. Well, with a consolidation, there is no consolidated general ledger, so the worksheet becomes our tool for recording the items or posting the items. And you'll see as we go forward, since that worksheet is not a general ledger, we do not have the aspect of items being carried forward as a permanent account. So you'll see as we enter chapters 3 and forward that we have to account for all periods on the worksheet because it's not accumulative. So that's our EL entry. Then we're going to post our D entry, which is how we distribute the excess. And what we're doing right now is we're saying, okay, we paid $720, investment that's on the trial balance of the parent. That $720 is partially due to underlying equity of the sub and partially due to values we were willing to pay above and beyond related to these excess amounts. So now we're going to distribute those excesses. So I'm actually even going to, just to save us a tiny bit of time here, going to copy those down here. And this entry will always come directly from that DDE. Now the one adjustment I have to make here obviously is that equipment is a credit. And the offset to all of this is the investment account. And the total to the investment account ties back to the DDE. In this case it's the full 380 because it's 100%. You'll see in our next example we will break it out a little bit when it's less than 100% using these additional columns. But for now our investment credit is 380. So I'll go ahead and post that into the worksheet as well. And you'll notice that when I'm putting credits into the worksheet, I'm putting them in as negative amounts based on debit kind of credit rules. The reason I'm doing that, and it's up to you whether you do it or not, is that when I sum across, it makes the math easier and I can do a really quick Excel function to sum across. So it just saves a little bit of time. Alright, so that's all of my entries posted in there. Now I want to make sure that my entries balance. So I'm going to do a sum function for the totals. And we see here that they do not balance, so I need to obviously calculate or figure out why they do not balance. And hopefully you already see my error or what I'm missing. By copying from above, I didn't come down here far enough to pick up the goodwill. And I'm going to go ahead and leave this recording with that issue in there because I want you to see how you work through issues when you discover something is not in balance. Okay, you obviously go back to the sources, etc. Now we see that our entries balance, and that's the goal there. Now again, in chapter 2 we haven't had any time. This is at the exact same purchase as the date that the subsidiary is acquired, so not a lot's happened here. So I can go ahead and do my sum across. Again, since I don't have any income statement activity, it's pretty straightforward here. And the advantage to putting those columns in with negatives is that I can highlight what I want to be summed across and the column I want it to go into, do my auto sum feature, and the worksheet fills in for me. And you'll notice that in total I balance because my trial balance on my consolidated balance sheet still foots to 0. Now there's a couple of cleanup things we do have to do, and I encourage you to look through the consolidated worksheet. So we'll see that combining them as an economic unit, we have total current assets of 80, total inventory of 200, land of 190, etc. Now what you'll notice though is that the investment account still has a balance, and it shouldn't, because the investment account is not something that is outside of the economic unit. It represents us having an interest in the sub. So I need to adjust the formulas because it only goes across on one line, and sometimes our adjustments take us into multiple lines. So I'm simply moving my 380 adjustment to the line that it belonged to. So now my investment account comes out to 0. There's my liabilities. You notice I have no balance for subsidiary equity because I shouldn't. There's nothing being held by an outside party. And then I have the equity of the parent, and it foots down to 0. And that completes our first example using problem 1. And we'll complete another example based on similar information here, but less than 100% ownership, looking at problem 2.